Welcome to the Oregon Pacific Financial Advisors annual State of the Markets presentation. We are delighted to spend a few minutes with you here today and look forward to sharing some important information with you. Take a moment to review these disclosures. If you have any questions on these, please let us know. Today, I'm going to focus on 4 key questions. How did stocks perform in 2020? What drove market performance in 2020? Where are we now? What do financial professionals forecast for 2021? So let's jump right in and begin with a recap of an extraordinary year. Right now, we're going to take a look at how a volatile and unprecedented 2020 unfolded and what 2021 may hold for investors. No one could have predicted how the pandemic would roll the markets throughout the year. Stocks plunged in March and April from record February highs as global economies seized up following the economic restrictions and lockdowns put in place to control the spread of the coronavirus. Stocks staged a massive rally from March lows as major stock indices repeatedly set new highs throughout the course of the final 2 months of the year. Indicating just how difficult it is to predict the markets, stocks closed the years well above the pre-pandemic expectations of large Wall Street market analysts. The coronavirus pandemic was the dominant influence on stock market performance in 2020. In addition to the unprecedented pain it caused for so many in the US and abroad, it also impacted everything from Federal Reserve monetary policy and government spending to business results and economic performance. In the following few images, we discuss each factor separately and in more detail. First, though, let's look at how these factors affected stocks over the course of the year. Stocks started building on the previous year's gains, but dramatically reversed in March and April as the coronavirus pandemic began to spread to Western Europe and the United States. It was only after a series of unprecedented monetary and fiscal policy actions that stocks began their long climb back to pre-pandemic levels. Stocks eventually moved past the highs established earlier in the year in the wake of November elections and the announcements of successful Phase 3 COVID-19 vaccine trials. Stocks finished strong into the end of the year, buoyed by the approval of 2 COVID-19 vaccines and the passage of another fiscal relief bill. As you'll notice, we've color-coded our 4 key market drivers, identifying dates where each of these factors moved the market significantly. The S&P 500 is an unmanaged index that is generally considered representative of the US stock market. Keep in mind that past performance does not guarantee future results. Individuals cannot invest directly in an index. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. COVID-19. It isn't often that global pandemics drive market action, but that was certainly the case. As you see in February and March, we identified 2 key days that were really the opening act on the coronavirus pandemic that affected so many Americans. Markets were initially slow to react to the danger, but as the implications became more understood, markets staged a broad retreat. In record time, as we see in December, the FDA approved the first vaccine for protecting Americans against this dangerous virus. Monetary easing and fiscal policy. In response to markets that were seizing up, the Fed stepped in with an unprecedented series of actions, including cutting interest rates to 0. The federal government followed with its own unprecedented actions by bipartisanly agreeing on a massive $2 trillion spending plan, the CARES Act, to provide individuals and American businesses with immediate relief. These actions ended up setting the groundwork for the eventual recovery that is illustrated by this graph. The economy. With the spreading virus and widening economic lockdowns, the economy shrank, with the worst of it occurring in the second quarter of the year. The economy rebounded thanks to the fiscal and monetary steps we just discussed, as well as due to the summer months that typically result in slowing viral spread. Corporate earnings. While most investors gave a pass to companies about reaching pre-pandemic earnings targets, investors were often finding themselves surprised by the strength of earnings given the economic landscape. This was especially evident following the close of the second quarter. Earnings have since continued to rebound, but for many industry sectors, there remains some ground to make up. The Federal Reserve was already on a path of lower interest rates in response to a slowing economy, implementing 3 rate cuts in the second half of 2019. As the coronavirus pandemic economics impact became more apparent in March 2020, and amid a slumping stock market and a tightening debt market, the Fed implemented unprecedented reductions in the federal funds rate. The Fed's policy response to this unprecedented economic challenge wasn't limited to cutting the federal fund rate. As you'll see in the next image, the Fed pulled several levers to address the immediate dangers facing the economy and capital markets. These are just some of the steps the Federal Reserve took to combat the disruptions resulting from the multiple disruptions COVID-19 caused. Many of these items are esoteric, but don't worry, there will not be the test at the end of this image. However, it's important to see the range and scope of the Fed's actions in just a few short months. Stemming from the lessons learned during the 2008 credit crisis, the Fed's actions were much quicker and more decisive in addressing strains in the capital markets. Beginning with a surprise Sunday evening press conference on March 15th, Fed Chair Jerome Powell announced a drastic reduction of the federal funds rate to a range of 25 basis points or 1/4% to zero, and committed up to $700 billion in asset purchases to maintain liquidity in the credit market. Initially, the market greeted this move negatively, believing that the Fed saw more trouble than the market had factored into stock prices up until that point. As the timeline illustrates, the Fed continued to implement new measures to steady the financial markets. While the Fed implemented more programs than we have outlined, let's take a look at some of the key policy initiatives put in place during the worst of the market slide, including the following. The creation of a commercial paper funding facility to buy short-term unsecured debt was crucial to ongoing business funding. The creation of a money market mutual fund liquidity facility to promote the purchase of assets from money market funds, ensuring value preservation. Money was provided to support credit to large companies and revived the 2008 Term Asset-Backed Securities Loan Facility, or TALF program, to prop up corporate bonds. With the passage of the Paycheck Protection Program and the extensive distress in small businesses nationwide, the Fed introduced a lending facility to buy PPP loans. This helped to facilitate bank participation by taking non-performing loans off of banks' balance sheets. Sweeping changes were introduced to the Main Street Lending Program to make it possible for a broader range of small and medium-sized businesses to apply. Now, what does all this mean? Remember the previous image that showed the stock market performance in the first half of the year? On May 18th, stock notched another solid gain when the Federal Reserve restated its commitment to do whatever would be necessary to support economic recovery. With an economic shutdown amid increasing COVID-19 cases, corporate earnings dropped and future earnings became challenging to project. In fact, many publicly traded companies stopped providing investors and Wall Street analysts with forward guidance. Absent such guidance, and in the face of economic contraction, Wall Street analysts cut 2020 earnings estimates multiple times. It turns out that the economy rebounded faster than many expected. In fact, many companies surprised investors with better than expected numbers in the third and fourth quarters. Overall earnings were still weak, but the fact that they were better than feared lifted investor sentiment. If you look at the overall year-over-year earnings growth rates, you'll see that they fell into negative territory in 2020, although analysts expect they will eventually begin growing again by the first quarter of 2021. especially given the prospect of widespread distribution of a COVID-19 vaccine paving the way for economic growth. So we've looked at some of the factors affecting market performance in 2020. Now let's examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in the year ahead. Here we see a group of 20 indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is positive for the economy. We might call that a tailwind, helping to push economic growth along. Yellow is caution, and red is a headwind, which acts as a potential brake on economic growth. As you can see, this chart shows where we were in 2010. We see a lot of green on the board. The economy was beginning its sustained recovery from the 2008 credit crisis, and the main risks at the time were volatility levels and the political environment. The only indicator flashing caution were credit availability and housing and mortgages. As we entered 2020, the economy presented a mixed picture. As you can see, there were several green indicators signaling potential economic strength, but also a near equal number of caution indicators, including the leading economic indicators in the yield curve. Plus, there were 2 measures in the danger zone: geopolitical risks and the political environment. As we approach year-end, the economic indicators pointed to a mixed picture of the economy. As you can see, only 7 of the 20 indicators are in the green, including monetary policy, which remains accommodative, housing, which has been a source of strength, and the index of leading indicators, which is a modestly positive sign. 4 indicators are signaling red, most notably in current equity valuation levels. Finally, many indicators, nearly half of them, are indicating caution. Weakness in consumer sentiment and the labor market may be the most troubling, since our economy is normally driven by a healthy consumer. Let's delve a little deeper into one area of these speedometers, the leading economic index. This measure includes 10 components ranging from stock prices to manufacturing orders. When examined together, this data may give a clearer, less volatile view of where we are. The latest report shows continuing modest growth, suggesting that economic recovery may continue into 2021. As you can see in this chart, recessions have never started when the LEI is increasing. Of course, the country has never confronted the prospect of another potential wave of COVID-19 infections that could lead to another economic slowdown. A vaccine would surely help mitigate this risk, but it remains uncertain how broadly and quickly distribution can occur. It's important to remind people that past performance does not guarantee future results. But as we review charts like the leading economic indicators, history can help suggest where we are in the economic cycle. We just saw from the leading economic indicators and the economic speedometers that the economic outlook is a bit uncertain. Recovery from the coronavirus-induced recession remains fragile, especially in light of a resurgence of COVID-19 during the winter season and the economic lockdowns that may follow it. We see several headwinds the markets could fight in the year ahead. While the COVID-19 vaccines are a hugely positive development that may help speed economic recovery, there remain outstanding questions about how quickly vaccines can be distributed and the willingness of Americans to take them. Hiccups in either the distribution or the number of Americans taking the vaccine may unsettle the markets. Even as most expect the economy to grow in 2021, the economic scarring of the pandemic remains a question mark. We do not know how fast Main Street businesses will be able to recover, or how many may be unable to recover at all. Corporate balance sheets for many industries, such as the travel and hospitality sectors, have been damaged in a way that may limit these companies' abilities to rehire workers, invest to grow, or generate profits amid reduced revenues. As this economic scarring reveals itself, it could provide an obstacle to the markets. While bond yields may be expected to remain around historical lows, many professionals anticipate that rates may rise above today's levels as economic growth accelerates and the demand for credit increases. Rising yields could weigh on stock valuations, affecting the overall direction of the market. Geopolitical events are a perennial wildcard in any year, and for the most part are unknowable. Renewed saber rattling by North Korea, a Russian invasion of a neighbor nation, or China threatening Taiwan, along with any number of scenarios, could upset markets and send them lower, regardless of other positive factors that may be in play. We believe that there are a number of tailwinds that could continue to support economic growth in 2021. The rollout at year end of multiple COVID-19 vaccines bodes very well for the economy, since protection against the virus is essential for getting people out of their homes and opening up local businesses. We'll need to keep an eye on the pace of immunizations nationwide and Americans' willingness to receive the vaccine, but early days provide reasons for optimism that this pandemic may be nearing its end. The Fed has stated that it will continue with its policy of low interest rates, even in the face of inflation that may exceed its target rate of 2%, provided that such excess inflation is temporary. A looser monetary policy should continue to act to support a recovering economy and securities markets. As the economy rebounds, corporate profits have the potential to expand meaningfully and from an investing point of view compare very favorably with prior year pandemic depressed earnings. These favorable year-over-year earnings comparisons may support continued positive investor sentiment. Economic recovery should lead to lower levels of unemployment, providing greater economic stability to the newly reemployed and greater confidence more generally among consumers. A more confident consumer is likely to spend more, a good thing for American businesses. This confidence could also unleash the robust savings that Americans accumulated during the pandemic, leading to potentially higher spending than many might otherwise expect. While it is expected that a Biden presidency will remain tough on China, many professionals believe that Biden will pursue negotiations more quietly and behind the scenes and in partnership with our allies. It is also anticipated that President Biden will seek to reduce the friction between the U.S. and our trading allies that flared from time to time over the previous years. Many think with reduced tensions, American businesses will feel more confident about making certain business and investment decisions as the level of uncertainty declines. Few professionals expect inflation to rise in any substantial way, at least over the next year. Inflation may pick up thanks to the fiscal and monetary stimulus of 2020 and increased consumer demand, but any increase is viewed as unlikely to move the Fed from its current accommodative policies. Next, let's examine this chart to see where stock prices are trending against historical averages. The most common way to do this is to look at the PE, or price to earnings ratio, which is a measure of what investors are willing to pay for a company's earnings. If you look at the dotted line in the middle, you can see that the PE for the last 25 years is on average 16.46%. You can also see that the PE moves quite a bit, with a peak during the dot-com boom and a trough during the credit crisis. As of September 2020, the PE was at 21.54, which is more than one standard deviation above its 25-year average. It may bear mentioning the big technology stocks, which because of their growth prospects typically sport higher PEs, represent a greater proportion of the S&P than ever before, so a comparison to the past may have limited value. Before we move on to a look at 2021 forecasts, it may be helpful to review the expectations around COVID-19 vaccinations, since so much of what the market and economy can be expected to do may depend on how effectively and quickly the country can vaccinate its citizens. Let's quickly review a snapshot of those expectations. December 14th, 2020, the first group of Americans received the COVID-19 vaccine. The end of 2020, forecast was 20 million Americans will have received a vaccination. However, that figure was closer to 5 million in reality. At the end of January 2021, it is estimated that another 20 to 25 million Americans will be vaccinated, or between 40 and 45 million. Based on the initial vaccination data, that number appears too high. End of April 2021, President-elect Biden has promised that 100 million Americans will get the vaccine within the first 100 days of his presidency. Now, it is important to note that each state will be responsible for the prioritization of who receives the vaccine and the distribution of it. This has the potential of achieving these national objectives, as some states are better equipped or more capable than others in executing such a rollout. We've talked a lot about what impacted markets over 2020 and what may impact markets in 2021. Now, let's see what the professionals have to say about where they think the market is headed. Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little inflation can be a sign of economic weakness. Inflation remained low in 2020, as the prices of consumer goods and services rose just 1.2% year over year. Food and energy prices are broken out, since they tend to be more volatile from month to month. As you can see, the increase in food prices was substantially higher than the overall basket of prices, rising 3.7%. However, the other volatile category, energy, fell sharply. Energy costs declined by 9.4% due to an oversupply of oil and the economic slowdown that reduced consumption. When excluding these more volatile sectors, core consumer price index, or CPI, was higher by 1.6%. Inflation is only one of the key indicators that the Federal Reserve uses in determining the level of interest rates. Currently, inflation is below the Fed's target of 2%. The Fed has said that absent persistent above target inflation, they do not foresee raising short-term interest rates anytime soon. The economic slowdown we saw in 2020 represented downward pressure on an already tame inflation landscape. While most observers do not see inflation as an imminent concern, some have voiced worry that excessive fiscal and monetary stimulus may, in the long run, cause inflation to flare higher. The unemployment rate spiked in March and April as the economy began to shut down, steadily recovering over the subsequent months. As we saw in an earlier slide, unemployment is expected to fall further as economic activity continues to recover. A healthy employment picture has historically augured well for the economy. It is also worth pointing out that we also saw a substantial rebound in wage growth. While ordinarily viewed as a healthy positive for the economy, the jump in wages is mostly due to the combination of a quicker return of higher paying jobs and the slow return of low paying jobs, skewing those numbers. So, what are the professionals forecasting for domestic equities in 2021? On average, they are expecting a healthy increase from the 2020 close. None of the highlighted analysts expect a down year, as expectations for increased fiscal spending, continued monetary accommodation, and a vaccinated American public are expected to translate into economic expansion. Of course, no one knows for sure what equities will do in 2021, and predictions at this stage are just that, predictions. However, these analyst perspectives show that for the most part, Wall Street remains highly optimistic. We've covered a lot of information tonight. If there's one takeaway here, it is that the path the market takes is never a straight one. Even in a good year, the S&P 500 can suffer substantial declines. But for the patient, long-term investor, stocks have shown themselves to be an excellent means for growing wealth and helping them pursue their financial objectives. Let me draw your attention to two specific examples of this. Look at this series of positive annual returns in the 1995 to 2000 period. Even as the stocks ended the year higher, each year was marked by meaningful intra-year declines. Also note that bull run followed the credit crisis, a bull market that saw multiple years in which intra-year declines were double digits. Of course, the year that just ended is a case study in a market that suffered deep intra-year declines, but ended up providing solid gains for the patient buy and hold investor, even if it didn't seem remotely possible from March's vantage point that stocks would fully recover and then some by year end. So what's the lesson here? Investors may harm themselves when they react to short-term market drops. In our view, the best decision for investors is to pursue their goals based on their time horizon, and risk tolerance. What can you do in 2021 to move closer to your goals? Here are some action items for you. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births or deaths. We also care about health issues, employment changes, and any financial developments like an inheritance that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you're feeling about investing changes. These could be details like a shift in your risk tolerance or any concerns about the market environment. Finally, remember to go over your estate planning documents, beneficiary designations, and other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to talk through whatever financial questions, worries, or excitement you may have. Our priority is to always help our clients make informed decisions and stay on track. Throughout 2021, we remain focused on delivering the following. We'll keep our clients informed through regular communication. We manage our clients' investments according to their personalized strategy, and we stay on top of changes in the market environment and make prudent adjustments when necessary. With that, we'll end today's presentation. Please feel free to reach out to us with any questions. You can reach out through our website, our email, or by giving us a call at the numbers listed on the screen. Thank you so much for taking the time out of your busy day, and we look forward to hearing from you soon.